Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork, and happy Friday. It's Friday the 13th of October here. Hopefully be safe this weekend here, right? Hey, we got a few economic news to go over, and we got some pretty big ones today, so we'll jump right into it. We'll start with the Consumer Price Index, also known as the CPI, for the month of September. So August, we had a pretty big jump of 0.4% increase. Forecast for September was supposed to be 0.6% increase and went up to 0.5%. So that brings the year over year, the headline number at 2.2%. But when you strip out the food and energy, which is what we really look at, is what we call the core, and basically because of volatility. And the reason obviously you're going to see September go up is because the food energy price went up as we had the hurricanes. So you saw oil prices and everything else kind of going up in that process. Now, it was much tamer, as you can see here. Back in August, it went up only 0.2%. Forecast supposed to continue at 0.2%, and it went up only at 1.1%. Now, this is an important gauge primarily because it gauges inflation on the consumer side of things, and that's really what we look at is consumer versus what we saw earlier in the week with the PPI of the wholesale side. Now, year over year for the core came in at 1.7%, still below the 2% range that the Fed does. But the favorite gauge that they really look at for the inflation is the PCE, personal consumption expenditure. That's the one that they really look at, and that year over year keeps dropping down. It's at 1.3%, and CPI they kind of look at more towards the 2.5% range. But again, the PCE they like it because it's got more flexibility, so it takes into trends if consumers that if one thing goes up that they might transfer or trend to a different direction and buy something else. So it kind of takes those into, that's why they consider that a little bit more accurate. Now, also we got retail sales for the month of September, and they dropped in August at 0.2%, but September it went up. Forecast supposed to be 1.9, and it came in at 1.6. So a little disappointing, but it did go up, which is obviously good news. But when you strip out the big ticket items that can really throw off these numbers and really skew them, we got the 0.2% back in August. It was supposed to go up 0.8%, and it exceeded that at 1%. So that's actually a great number that we were able to raise overall our retail sales without the big ticket items, autos. So then consumer sentiment, October. So we had 95.1. It was supposed to stay in that range for the month of October, and it went up to 101.1. This is a hot number. This is actually a number we hadn't seen since 2014. So in 13 years, this is the best number we've seen in the consumer sentiment, where people are obviously feeling good about where things are moving. So this is obviously very good news here, and that's actually before obviously the credit crisis. Last but not least, a little mild one here is business inventories. So in July we had a 0.3% increases, and in August they geared up even more. So this is important primarily because this helps us gauge as to they're going to create more jobs. So if they're stocking more, they're going to obviously have more jobs, be hiring more. So this is obviously good news right here that businesses are gearing up to hire more people here. So let's take a look here at the headline news here. There's not a whole lot going on here. Stock market's up a little bit. They're reaching, they keep closing up with intraday highs, with new heights here. It keeps rising week over week. It'll be modestly higher, but for the most part, they're kind of not really doing a whole lot. There's been a few disappointments in the earnings reports. As yesterday was the big day for the first round of them, and then today we have day 2 of it. We had Wells Fargo disappointment because of all the bad press it's been getting on the mortgage news and stuff like that, and everything else. But then you got Bank of America did okay, and then sometimes the earnings are disappointing, but the profits are up. So it's kind of, they call it based on considered a lot of those mixed news, so to speak. And earlier this morning, President Trump came in and basically said that they're going to stop the subsidies for Obamacare, and because basically he says it's unconstitutional. This program in itself is constitutional, therefore they can't allocate, don't have any allocation for it. So, so this is kind of came up out. Seemed like came up out of nowhere. So again, this is going to create some confusion as to those who are on it as to how they can continue with their insurance, what's going to raise a lot of questions. So hopefully a lot of people won't be dropped in the meantime. So So let's go ahead and go forward here and see how the bond market's reacted. Bond market's having a great day today. We're up about 17 basis points, so we're up against this, passing this Fibonacci line, and now we're up above the 100-day moving average and fastly approaching the 25 and 50-day moving average. So this is good news here for the bond market as well. So what does that mean? It means interest rates are improving for home mortgages. So let's take a look at the yields, and right now we're down about 4 basis points. So we're going from about 2.32, 2.33, all the way down to about 2.28 right now. And now it's below the 200-day moving average, whereas it's been kind of this floor support. As you can see, it kept testing and staying above it. Now it's dropped below that, and that's good news for mortgage-backed securities and interest rates for us. So that pretty much wraps it up for the day, or even for the week for that matter. I hope you guys have a great weekend, but if you guys want to get more data, just come over to Twitter. I do post throughout the day, including market closes on Twitter. I'm underneath the handle of Mike Bjork. And I hope you guys enjoy your weekend and look forward to see you guys on Monday. Thanks again for watching. We'll see you guys then. Bye-bye.